Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week's topic, guys, is on wide range bars, range expansion bars, and pivots, and how they all tie together, how we use multiple concepts converging in one area so we can make our trades a little bit more reliable, learn better exit points, keep us out of bad trades, and know when stocks generally are going to reverse their trend or reverse their direction. It's a very, very important topic. It's a topic that many of you are struggling with. Before we get into that topic, though, I wanted to make a couple comments. I've been getting some emails from folks saying, hey, Jared, I'm struggling with discipline. Discipline. It's a very challenging thing for me to handle. And one of the things you need to understand is that trading is a very different type of business, okay? You don't have a boss. You don't have somebody looking over your shoulder. Normally in life, you have some form of a boss. You have either your spouse keeping you in check. You have society keeping you in check. The police keeping you in check. Something is keeping you in check, okay, from doing something bad or doing something illegal. There's consequence for our actions. Well, in trading, we don't have that much consequence, and we certainly don't have anyone to hold us accountable. So what you need to do, if you're struggling with discipline, what you need to do is find an accountability partner as well as a consequence system that is so bad, so egregious, so difficult that you would never, ever break the rules of your trading plan. Right? So here's a silly one. It's not silly, but it gives you the idea of what I'm talking about. A consequence system that's so severe. For example, if you break your trading plan, or if you sell too soon, or if you don't take a stop loss, you got to go eat a cow eyeball. You're like, what? A cow eyeball? Exactly. You would never think to do. That's disgusting. Go watch Fear Factor. Find something crazy they do on Fear Factor. And every time you break your trading plan, you have to do something from that show. All right? Make it more severe than that. But whatever it is, it has to be so severe, so incredibly yucky, or something you would never, ever consider doing so that you won't break your trading plan, right? You won't sell too soon. You won't overtrade. You won't not take your stop loss. It has to be something really, 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 really bad. Because you know what the alternative is? Quitting trading, blowing up your trading account, going back to your boss with your head between your legs going, I'm sorry, I need my job back. You don't want to do that. So make it something very, very severe. So anyway, back to today's topic, guys. I went off a little tangent, but I've been getting a lot of questions about that. So wide range bars, range expansion bars, and pivots is today's topic, guys. And it's very important simply because, one, it'll help you get into trades sooner, okay, at better entry points. It will also help you determine when a stock is going to change direction. Why is this important? Because that will help you get out with more money. So you're not holding a stock past its profit point when it's actually going to go against you and you're going to sell for a lower price. Know when it's going to pivot. That will help you with your targets. And lastly, it will help keep you out of bad trades. I see so many traders getting into stocks that are up 3, 4, 5, 6 bars in a row. You're getting into stocks after wide range ending bars. You're getting in when the stock is actually just about to pull back. You're doing the exact opposite of what you're supposed to be doing. So today's lecture is very, very powerful, guys. Look, this isn't I'm not some YouTube creator here, all right? That's just putting out content that makes you feel good. This is real, valuable, helpful trading information, okay? So I see a lot of these other accounts just blowing up, and I'm happy for those creators, but this is real hardcore trading information for people that really want to actually make money in trading, not just feel good all the time, okay? So no safe spaces here. I'm Jared Wesley from Live Traders. Let's get to it. This week's topic is how to profit from wide range bars and pivots. This is a relatively new lecture. We were just talking about, I've done a lot of lectures on a lot of different topics, and I'm pretty sure, and I went through all my files and a lot of different stuff, that other than one slide, I think almost everything in today's lecture is brand new. I haven't done before, and that includes, to some extent, PTS. These slides are not in there. So it should be an interesting one from that perspective. And I think it's also something that got me thinking the last couple of days when people are looking at certain stocks they want to trade. And I'm thinking, wait a second, that's a wide range ending bar. Why are you looking to get into this trade? So I thought wide range bars and pivots and how they correlate to each other is important, because I think there's a lot of people taking entries that they shouldn't be taking. So we'll talk about how range expansion bars, wide range bars, even a little bit narrow range bars and pivots play a role in your trading with regard to helping you get into trades earlier, keeping you out of bad trades, and also helping you get out of a good trade at the right moment. Because a lot of times stocks get extended, a little bit climactic, and they're about to pull back. This just happened. I think it was on NOVN yesterday, and somebody's like, how did you know it was going to pull back? Well, we're going to talk about some of those things today, okay? However, before we get into any of that good stuff, we have to talk about when will the insanity stop. This week, I have 2 stories for you, or whatever you want to call it, and a lot of people, for whatever reason, I don't know why, but they get more excited when there's a big number, like, ooh, somebody lost $1 million. Well, I don't think those are the ones that you should be caring quite as much about. Because that's insanity and stupidity on just a whole nother level. And if that person had a few $100,000 or $1 million, they're probably doing okay in other areas of their life. The ones that you should really be getting upset about or really disappointed with, or the ones that hit home the most, should be the smaller versions of them. So that's what I have a little bit today. The numbers aren't nearly as big, but I think it applies to a lot more people. Okay, so the first one is an email that somebody sent me. Okay, I'm just going to get to the crux of it. After making 3 successful trades and made over $400 in one day, that's 8R. So this person was up 8R. They have $50 risk, so they made 8-to-1 return. I had a small account. This obviously got me thinking and seeing opportunities that were not there, buying dips, and ended up losing $1,000 after 24 trades, wait for it, in one day. This is one day, okay? So this person went from plus 400 to minus 1,000. That's a $1,400 swing. And it says, I know I'm a fool. I burnt pretty much my account for the second time. After having a nice day, I can't stop trading. What do you recommend? Now, in terms of sheer money, blowing up $1,000 or $1,500 accounts, not that crazy. But this applies to a lot of people out there that have $2,000, $3,000, $4,000, $5,000 accounts. And when you blow them up, it's a lot harder for you to get that $3,000, $4,000, $5,000 back. Somebody who's got $300,000 could probably pull another $20,000, $30,000 from somewhere else pretty simply. But this is a person that was up $400 on 3 trades and then went on to take ultimately 24 trades, and they ended up losing $1,000. But what's key here is I blew up my account for the second time. Once wasn't enough, had to do it twice, okay? And as I just alluded to, it's generally a lot harder for somebody like this to re-up their account again, right? To open up a new account again. I know I can be a successful trader, but don't know how I can control the insanity. I'm going to give you guys some brief advice because I don't want to spend too much time on the insanity. I say this frequently in the chat room, but this is very important. See, what makes trading so difficult, other than the fact that it preys on our emotions, is there's no accountability. There's no consequence to it. There's nobody looking over your shoulder saying, don't do that. In most jobs, you have a boss that will do that. In a marriage, you have a spouse that will do that. In society, you have the police that will keep you in line, in check, etc., and so forth. But in trading, we don't have any of those things. So who is going to keep you accountable? Who is going to force upon you some form of consequence? That's the question. So what you really need to be doing is building or formulating a consequence system that is so severe, so great, so incredibly bad that you would never even think about breaking your trading plan. And I know I use crazy analogies sometimes, and again, I apologize if it offends some people, but if you have children and somebody stuck a gun to your kid's head and said, well, if you sell that trade too soon, I'm going to pull the trigger, you wouldn't even think about selling that trade too soon. You'd be like, all right, set my bracket order, I'll walk away. I kind of love my kid a little bit. So you see what I'm saying? Now that sounds crazy to some people, but find something that's so important to you, you would not break it. Some people are saying, jeepers, Jared, that's a little drastic. It's not. It's not. You know what's drastic? You guys blowing up $30,000 accounts, $100,000 accounts, and going back to your job and then talking smack about trading like, oh, that stuff doesn't work. That's drastic. Why? Because if you can get that under control, and I'm not exaggerating when I say this, and you know me, I'm usually more on the hardcore negative side with certain things. This business will change your life. I don't use those terms that often, but this business will change your life if you can figure that part of it out, because you can do it from anywhere you want in the world and not have to answer to anybody. So figure out something that means so much to you, and then take it away from yourself every time you break your trading plan. If that doesn't do it, then this isn't the business for you. I mean that sincerely. If that's not enough, then this isn't the business for you. Okay? All right, next one. Insanity knows no borders. Ooh, I got this one a couple days ago. Insanity knows no borders. Okay? I probably should have taken this person's name out, but whatever. It's not about them. It's about somebody else. This is from the Indian stock market. Okay? And no, Unmol didn't send this to me. All right? This is somebody who had a $1,341 account, and this specific trade, I don't know anything about Reliance Industries Limited India, nothing about it. My point I'm saying is insanity is applicable to everybody on the planet. It's a human condition, okay? So this person didn't have a huge account, but they were up, or they had $1,341 in their account, and on this trade, they took it down to $1. Okay, I only know that because I did the exchange rate in here. I have no idea what 100,000 INR is, but now I do because of Google, Indian rupees. Okay, so 100,000 Indian rupees equals $1,341.60 as of yesterday. Could be different today. The point simply is, it doesn't matter where you are in the world. It doesn't matter what stock market in the world you're trading. This stuff really happens, meaning pullbacks happen. And if you don't have a stop loss, you're due to be in a segment of when will the insanity stop. So please, stop the insanity. Put a stop loss in. Be smart. Live to fight another day. I want you to always keep that in the back of your head. I know it hurts to take a loss sometimes. I know. But live to fight another day. Pride, greed, all those things. Exactly. All of those things. Live to fight another day. Don't you think this person would have rather have lost $50 or $30 and still had $1,300 left? Yeah, I bet they would. Okay, I bet they would. All right. So now let's dig in, guys. All right, let's dig in. I wanted to go over this particular play before I dig into the pivots and wide range bars. Okay, this is a play we took yesterday on MRNA. And it says, good 3-bar play, question mark. Right, and if you look at the parameters of a 3-bar play, wide range igniting bar, check. Narrow range resting bar, check. In the lower 50%. Bar number 2 is in the lower 50% of bar number 1's range. Check. Okay. Bar number 1 and bar number 2 have relatively equal lows. Check. Right? And void below, at least on a 1-minute chart. All right. So right there, you're looking at a stock on, wow, okay, this has a bit of a topping tail, a nice wide range red bar, followed by a narrow range red bar on bar 2, a little topping tail there, doji bar, etc., and so forth. And all in all, so far, we've hit all the checks. Check, 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 check. And it was on the short list. So we're not going against our gap list on this. It has a lot of things to like, 5 different things. So you sit there and go, wow, that's pretty nice. Pretty nice, okay? But there's always a but, or else I wouldn't have it in here, okay? What is, and this is important, we'll get to it on the next slide in just a second. What is your expectation for the trade? This matters. This matters, okay? If you have a certain expectation for a trade like 5R or 3R or a big move, this might not be the trade for you. And you're going, well, why? Why? It looks perfect. Well, right now, we're in a vacuum. Right now, we're sitting on a 1-minute chart, right? A 1-minute chart from yesterday on this. Well, when you think about a forest, okay, the daily chart or the weekly chart is kind of looking at the forest from above, like in a helicopter. You're looking down on the forest, and you're going, okay, I see the whole picture. When you get to a 60-minute or a 15-minute, now you're starting to look at individual trees. Okay, and then when you get down to a 5-minute, a 2-minute, a 1-minute, now you're looking at the branches of the trees, the leaves of the tree. And what happens when you're looking at a branch or a leaf? You're not seeing the whole forest. You're just seeing that branch or that leaf. So you're not seeing the whole picture. There might be a forest fire not far away, but you're so focused on that one tree and that one branch and that one leaf, you're not seeing what's happening around you. So I'm not saying this is a bad trade. I'm not saying it's a good trade per se. It all depends on expectations. So let's take a look. This happens to be the 15-minute chart. Okay, we could have gone to the 60 or the daily. I just think it's more clear or clearer on the 15-minute. This was a scalp trade. The question is why? Well, the reason it's a scalp trade is because there's not much room to play with this thing. This little purple or sorry, pink or red line right there kind of breaks this 15-minute support, but that's $80. Right below at $78, there's a pivot support here and a pivot support here. So we can't realistically expect MRNA to break 78 bucks. In fact, the room from 80 to 78 is pretty thin, $2, and there's a little bit of junk to the left. This is a challenging trade. So the point I'm making is know your expectation. I even put MRNA target $79 area because I wanted nothing to do with 78 bucks. Nothing to do with it. Why? Because there's a lot of support there. So if we go back one slide, it's not that this is a bad pattern. It's a beautiful pattern. But knowing your expectation makes all the difference in the world. If you're shooting for 3R on this trade, you can't take it. There's just not enough room to get to the target on this trade. Even though in a vacuum, looking at the branch or the bark or the leaf of the tree, this is really, really nice, right? So we'll take you to the actual trade, and this is what it looked like. Got in at 80.25, okay, in that area with a stop at 81. And the target was really 79. Unfortunately, it just missed the target by literally a nickel. It went to 79.05. Oh well. And then a bottoming tail came in and it bounced back up. And this should not be a surprise. Okay? In the fact that it bounced shouldn't be a surprise is what I'm saying. So I only made 460 bucks on this thing. We were hoping to make 600 or 700, but we missed that by a nickel. That's okay. But the other thing that's important here, and I want this to be clear, is this was an aggressive trade, but we were also lowering the stop loss all the way down. Does that make sense? We weren't waiting for 1R or 2R to lower the stop loss. We were treating this very, very short-term, narrow-range scalping. Okay? So as the trade went in our direction on this red bar, we're lowering the stop, basically decreasing our exposure on this trade. So did it turn out to be a home run? No, but it was never going to be a home run. That wasn't the expectation. So I wanted to get that out of the way, not just because of MRNA, but all trades you take, whether it's a core trade, whether it's a 1-minute trade, know the expectation before you take the trade. Because then you can manage it properly within that expectation. It's when you have an expectation that is not in alignment with the chart, that's when you have a problem. People get in a lot of trades and they're like, oh, I'm going to get $5 out of this, but maybe it only has $1 worth of room. Or maybe you're on a time frame like the 1 minute that's not conducive to getting a $5 run. So know your time frame, know the expectation. Okay? All right, on to the good stuff. This is the one chart in here, the one slide in here that you guys have seen before. I actually did a lecture on this, I don't know, 6 months ago, maybe, something like that. The larger the reversal bar is relative to the prior bar, the more compelling. I'm not going to spend much time on this, but what you need to understand here is reversals are important, meaning knowing when and where a reversal is likely to happen. And we do this by putting multiple concepts together. Okay, so over here we talk about a significant level of penetration, it's more potent. A shallower level of penetration is less potent. You're digging deeper into enemy territory on the left. You're not going quite as far into enemy territory on the right here. Same is true on the reverse side. So I'm not going to spend as much time on this slide. Why? Because I already did a lecture on this slide. But what I wanted to talk about today were wide range bars and range expansion bars. We're not going to talk as much about narrow range bars, but we're going to focus on wide range bars and range expansion bars. The first thing you have to understand about a wide range bar, what is it? A wide range bar is typically double or twice the size of an average bar. Now, I get this question frequently. How do you know what an average bar is? You look at the chart, right? You literally look at the chart and you say, okay, I'm going to pan my cursor across the chart, right? And go, oh, in fact, let's do it for a quick second. Let's do it. Let's take, I don't know, bib. All right, I'll blow this up real quick. Give me 1 sec here. Okay. So if I take a look at BIIB. This is a 5-minute chart. So if I look at BIIB, I can literally look at that and go, wow, this bar right here is about 12 or 13 cents. That's a narrow range bar. Okay. I can look at this bar over here and go, wow, that's $2, or now it's $1.20. That's a wide range bar. Okay. And I look over here. Okay. That looks to be about in the middle. All right. Well, that bar right there is about 30 or 40 cents. That's an average range bar. So you go from basically a 15-cent bar being narrow range to $1 being wide range. Average range is somewhere around 40 or 50 cents, 30 to 50 cents. So my point is there's no steadfast rule on what a wide range bar is because it's different for every stock. Okay? So you can clearly see the largest bars on the chart, but they could be super wide range. The point I'm making is just pan your cursor across the chart. That's it, across the chart. And find out, take a look at a couple small bars, take a look at a couple medium bars, take a look at a couple big bars and see roughly what the range is. Then you know, it doesn't take very long at all, right? It doesn't take very long at all, okay? So that's what a wide range bar is, okay? Twice the size of an average range bar, okay? And an average range bar is something that's case by case for each chart, all right? So a wide range bar is also considered a range expansion bar. But that also depends where it's happening on the chart, meaning sometimes they are different because a range expansion bar is exactly what the name suggests. It's expanding the range of the stock, but not every range expansion bar is buyable. And that's the key you have to get here. Some range expansion bars are actually ending bars, depending on where they happen on the chart. Okay, some wide range bars are ending bars as well. They're not always igniting bars. So a bottoming tail or a topping tail may or may not be a range expansion bar, okay, because you can have narrow range bars with bottoming tails and topping tails. All right, some bars have them, some don't, right? In this example, the range expansion bar has a bottoming tail, but the wide range bar doesn't. But like we just said, sometimes they can be one in the same thing. A wide range bar is and can be a range expansion bar. All right. Why are these important? Because wide range bars, range expansion bars, they show commitment and they show emotion. Basically, it's an increase in fear and greed. All right. And that's what you want to see, especially during a reversal. And like I alluded to, and we'll get to this slide a little bit later, this is going to help you determine when a stock is breaking out, when a stock is likely ending its move, and also when a stock is extended enough that you don't want to trade it anymore. So it'll help you stay out of bad trades. It'll help you learn when a stock is going to pivot so you can get into a trade. And it's also going to help you learn when a stock is going to pivot so you can get out of a good trade, right? Everybody wants to know when a stock is moving in their direction. Well, how do I know the move is finished? How do I know that we're going to talk about that? Okay. So a range expansion can be a warning that momentum might be slowing down or is close to reversing. Narrow body bars can also be range expansion bars, all right, but narrow body doesn't necessarily refer to the range, okay? So you can have a wide range bar that's narrow body. This is explained in professional trading strategy, so I'm not going to go too much detail here with it, okay? A breakout or breakdown with a wide range bar and after a consolidation usually ignites a move in that direction. Right? So what is a breakdown or breakout? It's a correction through time. We have two types of corrections, right? A price correction and a time correction. Okay? So a breakout is a time correction. So if you get a time correction plus a wide range bar, by definition, that's a range expansion bar. It's expanding the range of the stock significantly after a resting period. Okay? A narrow range or narrow body bar is typically more reliable after a wide range bar, okay? Without an increase in volume, the chances of that stock continuing are lower. I'm not going to talk as much about volume, and don't worry, this is going to make a lot more sense. Some of you are confused right now. It's going to make a lot more sense in a couple minutes when I get into the slides that, that show the examples of it, okay? So if you see a wide range bar and there's not much volume on it, be concerned. Be very, very, very concerned. Okay, we talked about that actually this morning on Coca-Cola, right? We looked at that 1 minute 3-bar play and it broke out above 48 by 3 or 4 cents with very little volume above the whole number. And I said, this is trouble. And it ultimately stopped us out. Okay, So keep that in mind. Volume matters with wide range bars and range expansion bars, because volume is what? An indicator of commitment or lack of commitment. So price tells us what is happening. The volume tells us how it's happening, with or without commitment, okay? A wide range bar, bearish wide range bar followed by a bullish wide range bar, and vice versa, are powerful turnaround play reversal signals, right out of the textbook. So if you have a wide range green bar that's immediately preceded by followed by a wide range red bar, that's a very potent turnaround, and that stock will likely go lower. Okay, so a couple more slides, and we're going to get into some examples. All right. Wide range bars after an already extended move usually signals a reversal, i.e. fear or greed is at extreme levels and likely unsustainable. So in this, if you're looking at number 2 right here, the second piece here, you have green bar, green bar, green bar, 3 green bars, one of which is a pretty good sized green bar, followed by what? A wide range green bar. Now, to many of you, you're sitting here going, yeah, duh, Jared, of course we know that. But many people don't. How do I know this? Because in the chat room, every single day, that's 5 days a week, there's not a day that goes by somebody doesn't ask about a stock that's already up 4, 5, or 6 bars in a row. Oftentimes, wide range bars in a row. They're like, oh, well, it's strong. I just want to hop on the momentum. Wide range bars happening after 4, 5, 6 bars up are much closer to a reversal than a continuation move. I will repeat it because it's the crux of this lecture. Most of the time, when you see a wide range bar that's already up 3, 4, 5, 6 bars, it is closer to a reversal than it is to a new move higher. Okay? So the difference here, if we focus on the left, is a range expansion bar typically starts at the bottom of the move, in the beginning of a move. An ending bar is exactly that. It's after multiple bars have already happened. So you can have a range expansion bar and an ending bar in the same move if the bar is big enough. We've all seen that before. What happens if you have a stock that normally does $1 a day in average trading range? Imagine, visualize $1 a day in average trading range. And then the market opens, it's 9:35 in the morning, and you see a $4 wide range green bar. One bar. On the 1 minute chart, $4. Well, that's both. That's a range expansion bar and an ending bar all in the same time, because it's 4 times the size of an average bar. So it absolutely ignited. It absolutely expanded the range, but it's absolutely the end of the move. So it is possible to have these all at the same time, but normally that's not the case, right? Normally it's not the case. So in this case here on the bearish side, red bar, red bar, red bar, red bar. But notice the bars are getting a little bigger, and then this bar is really big. So it's an increase in fear to the point where buyers are starting to say, whoa, this is a good deal. This is the right price. I want to get into this stock. And sellers are saying, get me out of the building, right? Just get me out. So that's where you see the increase in range, and preferably the increase in volume. Okay, so if you see the increase in range and it's already down multiple bars, and you see the increase in volume, basically the concept or the thought is all the people that wanted to get out just got out. So if all the people that wanted to get out just got out, there's very few people that are left to sell into me if I choose to go long on this stock. I hope you guys got that concept. So the fear has increased so much that all the people that wanted or needed to get out of the stock already got out. There's still a few stragglers left in there, but the stock is likely to reverse and go higher because there simply are fewer sellers to sell into the buyers. Okay? Now on the flip side, you have the wide range igniting bar that, again, you hope to see volume on, and this would come from a 3-bar play or a breakdown, something of that nature. Okay? So let's take a look at a couple examples. All right. So these are igniting moves. We'll start with igniting. So here's a stock that on a daily chart is pulling back here. It puts a little bounce in, bottoming tail, bounces about 100% retracement, pulls back about 50 or 60%, bounces again and consolidates for 1, 2, 3, 4, 5, or 6 days here. Okay.
And then the previous day puts in a pretty decent sized green bar. Not huge, but good size. And that's what? Right at the prior pivot high. Pivot here, consolidation here. So right around the $83 mark, there was a lot of resistance. But here's the positive news. This move down, this pullback, was a relatively smooth pullback. Okay, so the move back up should also be relatively smooth. But we're in the $83 area, but there's resistance. Sellers came in, drop. Sellers came in, drop. Sellers came in, but buyers are starting to show some strength. How do we know? Because the range is much narrower and it's at the top of the range. Notice over here, when sellers came in, they pushed the stock from 83 down to 74. Notice over here when sellers came in, they pushed it to 82.50 down to 78. Notice when they came in here, they stayed in about a $1.50 range from about $2, from about 83 down to 80.50. So the range is narrower, but it's also in the upper end of the range. That shows bullishness. And then you get what we call a wide range igniting bar. Now, in this case, you could consider this a temporary ending bar, right? It's a range expansion, wide range igniting bar, but it's a really big bar. So you might not expect this stock to go higher the following day because it's probably a little tired from this move. Now, the other thing I want to comment on that's very, very important. We never, and I do mean never, look at things in a vacuum, right? We just don't do it. That's poor trading. Okay, we're always looking at all time frames all the time, and we're looking for multiple concepts. So we talked about the forest. You're going to look at it from above in the helicopter. Then you're going to come down from the helicopter, right? And you're going to look at the trees, the branches, the leaves, the bark. You're going to inspect everything. So now it's like I have a total view. I have a total picture of this. All right. But on top of multiple time frames, we also need multiple concepts. So even though, and I've done lectures on this, so I think it's comfortable to talk about it, we're breaking above a trend line here. If you were to draw a trend line right here, you're breaking above the trend line. That's warning sign number one, right? So we have ending volume at the bottom. Warning sign number one is we break above the trend line. Then we put in a higher low. That's warning sign number two. We break above the moving average, warning sign number three. Then we consolidate in a very bullish, narrow range manner. That's warning sign number four. And then on the igniting bar, we get igniting volume. Increased volume shows increased commitment, assuming there is also increased prices. Okay, makes sense? See, if you have a volume spike with little to no price movement, that's danger. That's red flags, warning signs, get out of Dodge. Okay? But if you have an increase in volume and an increase in price, that's commitment. That's institutional money. That's $2 million in volume right there on a stock that normally does less than $1 million. Note, despite wide range bars, we're putting multiple concepts together here. Okay? Over here on the right-hand side, same thing. Okay? Here's a stock that's clearly in a downtrend. It bounces, pulls back, puts in what? A double bottom retest and failure. If you were to draw a trend line over here to the left, you would have broken above the trend line, concept one. Double bottom retest and failure without putting in a significant new low, concept number two. We break above the moving average, concept number three. So note, we're starting to get multiple concepts to converge here. And then on top of the multiple concepts, we get a wide range igniting bar right here. What does this bar do? It takes out this pivot, takes out this pivot, and just about takes out this pivot. Fantastic. Now, after the wide range igniting bar, because realistically, this wasn't buyable. Now, this is important. This one on the left was a buyable wide range bar because it happened as a breakout. This isn't really a wide range buyable bar right here. That doesn't mean we're not going to get another pattern later, and that's exactly what happened. So after this initial igniting bar, we get a flag or a wedge, okay? And then you get another wide range bar, okay? So in this case, these are wide range bars igniting moves. And take a look at both of them. They both have igniting volume on the wide range bars, okay? All right. Now we have the opposite. Now we have a stock that was in a downtrend, okay? And again, if you wanted to draw a trend line here, we're breaking above the trend line. We're putting in higher pivot lows. All that's fine. But now we have a stock that's up 1, 2, 3, 4, 5, 6, 7, 8, 9 bars. But note, on the 8th bar, it's a wide range bar, and it's already 8 bars up. And where is it coming into? Resistance, double top resistance, and volume. But that's not igniting volume, and this is not an igniting bar. This is an ending bar, and it's an ending volume. Why? Because of where it's happening on the chart. Okay, it's 8 bars up. Tremendous volume. So we just talked about all the people that wanted to sell a stock and how when all the sellers get out, there's less people to sell into you, so the stock should bounce. Well, the exact opposite is happening here. All right, all the people that bought this stock, the people that really wanted to own it, they bought it on this day. It went from 114 to 119, whatever it is, and the volume is 2 or 3 times normal. They're in it. So there's going to be a lot fewer people that are going to push us higher. And then you get the coup de grace, the creme de la creme. It gaps up the next day. This is like a sell off the open type trade. I mean, you're already up 2, 4, 6, 8 days. And then the next day you wake up after all this crazy volume and it gaps up. Wow. Goes a little bit higher and then just proceeds to roll over. Now, this doesn't mean that this stock's going to go back down to 104. It doesn't mean that at all. This is likely a short-term move on this stock, meaning the stock is so extended, it needs a short-term rest. In this case, it needed about, 2 weeks worth of rest before it started to climb back up. Why is this important? It's important for multiple reasons. One, you would never, ever, 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 ever take this trade right here. You're not getting into a stock over here. That's ridiculous. All right. And yet you guys are doing this every damn day. I see it in the chat room. People doing it every single day, getting into stocks that are up 5, 6, 7 bars in a row. Next, if you happen to be in this trade long, say you got in down here at 108, you're like, ooh, a little double bottom retest with a higher low. Is it aggressive? Yes, it's a very aggressive entry. But if you got in at 108 and you see this wide range bar right here on volume, and you see that pivot to the left, you're getting out of this thing. You're not holding it overnight for this gap up. You are getting out of this thing. Okay? You got a bigger move than I would have expected out of it. You're also at resistance. You're also up 7, 8 bars, and you also have massive volume. And here's the problem. You'll get out at 118, which is what you should be doing. Stock will gap up to 120, 121, whatever the next day, and you'll be sitting there going, I knew I shouldn't have got out of it. Right, like you're Nostradamus and you could have predicted the future the day before. No, you got out at the right spot if you got out at 118. That's the right thing to do. Just because it gapped up and it went up a few more bucks doesn't mean you didn't do the right thing. So stop chastising yourself for doing the right thing. Stop. Look, here's the thing. Sometimes stocks act irrational. And sometimes you have a wide range ending bar like this, and they might go up 3 more bars before it pulls back. That happens. But you can only go off the information you have right now. You don't know what the future is going to bring. That's why we have stop losses. Okay? Point is you're not usually ever going to get the exact top. So get over it. You play the odds. You play the percentages. It's up 8 bars. It's a wide range bar. It's at resistance. It has ending volume. Walk away. And be happy about it. Okay, and you can see it eventually pulled back. All right, this happens to be the craziest stock in the entire world. It might end up being one of the craziest stocks that I've ever seen in my life, Tesla. Okay, that and what is that other one, Nikola, whatever that company is. They don't even have a damn product, and they have like a $30 billion market cap. I don't know what the market cap is, but it's ridiculous for a company that doesn't even have a product. But anyway. This is a 65-minute chart. I put this on a 65-minute chart, guys, because for many of you, the 65-minute chart will give you the entire day because the market is what? 6.5 hours, 9:30 to 4 o'clock. So it kind of makes it even for the day. You can do a 60-minute chart. It doesn't matter. You can do a 59-minute chart for all I care. It doesn't matter. The concept here is the same, okay? What do we have? Well, we have a stock that broke out above 1,000, can't believe Tesla was even at 1,000, but that's a different conversation. Breaks out above 1,000, goes higher, consolidates, goes higher, consolidates, gaps up, consolidates, gaps up, consolidates. Elon Musk is maybe the greatest marketer we've seen in many years in America. Okay, Steve Jobs got nothing on Elon Musk, trust me, because Steve Jobs actually created some cool shit. All right, Tesla is just an overpriced car company. No, wait, it's a technology company, I forgot. And going to space is always such a profitable venture. Nonetheless, not the point. Consolidates for 3 days, okay? And then it rips. So think about it for a second. This is important. Stock was already pretty extended, right? It went from 1,000 to 1,400. That's a 40% move in 1, 2, 3, 4, 5 days. So a 40% move on an already well-established stock in 4 or 5 days, okay? Consolidating out 1, 2, 3, 3.5 days, okay? So it had a little bit of rest, and then this happens. It goes from 14 to 1,800 in basically 1 day, a day and a quarter, whatever you want to call it, right? So it ripped, and I know the market was up big this day, I get it, but it ripped, and then the next morning gaps up, puts in another super wide range bar here from like 1,650 up to 1,750, ultimately 1,800, and then what? Okay? Volume starts to come in. Big time volume. So if you're looking at the big picture here, 40% move here, 3-day rest here, and then another 30% move here. Was this igniting or ending? Well, it's ending. It has to be ending, right? It doesn't have to be. But when you're looking at the big picture and also look at the angle of the retracement. So this is not a range expansion bar. This is an ending bar. And then you get the doji bar. Why is that doji bar important? Because it's the first time we have seen what? Sellers creeping into this stock. Most of these green bars are opening at the low and closing at the high. Opening at the low, 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 closing at the high. This is the first time any semblance of selling pressure has creeped its way into this stock. Okay? And what happens? This is what happens. Right after that, this is what happens. So you have this range expansion bar right here. It breaks out. A $1,400 range. Breaks out. Pushes the stock up 1, 2, 3, 4, 5 bars. Really, it's up a little more than that. And then you get what? Wide range ending bar. What do you get over here? The doji bar. Sellers are creeping in. And I want you to also notice, okay, I didn't do a very good job of showing it to you, but see this wide range green bar here? See it right there? Go all the way down to the bottom here. Look at the volume on this doji bar next to it. See the doji bar next to it? See the volume? It's the largest volume up to that point that this stock has done on the 60-minute chart in 2 months. Okay? Let's actually put an arrow there so you guys can see this. Okay? Let's put an arrow there so you guys can see this. Take me a second. Right there. See the arrow? It's the largest volume spike the stock has done on a 65-minute chart in 2 months. And it happens to happen after the 7th or 6th bar up in a row, and the preceding bar was a super wide range bar. The expectation plays out perfectly. A pullback is coming. Absolutely a pullback is coming. Okay? So I'll take this off for now. You see it right there, okay? So the pullback is expected. And then note, as it pulls back, big bars, you get what? A bottoming tail at or near support. Bottoming tail at or near support with wide range ending volume. This is that combination of ending and igniting volume at the same time. So this stock has now pulled back, okay? It's rested a little bit there, okay? And it's pulled back near support, and it left a bottoming tail. So buyers are now stepping back up, and you can see that with the volume here. And then Tesla might chop around because it really is overbought, in my opinion. Significantly overbought. It was overbought at $200, but that's besides the point. It may bounce back up. It may pull back. I don't even know what it's doing today. I haven't checked. But you can see the range expansion over here on the breakout. You can see the wide range ending over here. You can see the doji bar. The doji bar is your first indication that sellers are creeping in. And it happens to happen with huge volume. Right? It happens to happen with huge volume. Okay? So this, guys, again, can help you, one, maybe short this stock up here as a mini climactic, or if you happen to be in this stock from the breakout of 1400, say, you know what, I'm going to take some shares off the table. I might even get out completely. This is likely going to be the turnaround. And it was. Okay? And it was. All right? Now, remember this stock from yesterday, NOVM. NOVN. Sorry, my apologies. NOVN. All right? This is what was an 80 cent, 60 cent stock. Gaps up, breaks out. By the way, great trade in the swing trading newsletter on this thing, guys. Fantastic. You guys wrote it from like 65 or 68 cents up to almost $1. And this thing ended up going to like $1.30 something. But just take a look at the pink lines here. Big move up. Red bar, topping tail, huge volume. What happens? Pullback. Big move up. What do you get right before the pullback? One of the bigger green bars on this move up. Big volume, pullback happens. What do you get here? 1, 2, 3, 4, 5 bars up. Wide range bar, huge volume, pullback. This is the first one I want to focus on, though, because this is the one I commented on in the chat room yesterday. I said to you guys, NOVN is likely to pull back soon. And somebody later were, well, how did you know it was going to pull back soon? It's a combination of being extremely extended. I mean, the stock did go from like 70 cents to $1.10. I don't know about you guys, but anytime a stock moves like 60%, it's kind of a lot, all right, regardless of the price. So this thing moved up, really extended. Topping tails are coming in. Red bar is forming. Huge volume. But guys, that was the biggest volume bar of the entire day. And take a look what this stock normally does. Take a look at the previous day. I mean, this stock does garbage for volume. Garbage. So today it's doing what? 50 times normal volume? I'm going to say, yeah, somewhere in the neighborhood of 50 times normal volume after an extended move in a red bar. Move's over, man. It's over. It pulled back and went higher eventually, but the initial move is over. Now, a move from 70 to 110 is pretty significant. Some people will stay in for the bigger move, but now what's NOVN doing today? It's all the way back down below $1 because it's tired. So wide range bars, guys, topping tail, bottoming tails, volume, we're putting multiple concepts together here. All right, we're putting multiple concepts together. OMI, I brought this up because somebody in the chat room mentioned it yesterday. Notice most of these examples are from yesterday because, well, there was a lot of good examples for this lecture yesterday. All right, so here's another one. 1, 2, 3, 4, 5, 6 bars up. Notice red bar creeps in right here. Stock's getting tired. To be honest with you, if I were in this thing long and I was trail stopping this, I would have put my stop really tight right here. Really tight. Because I wouldn't expect this stock to go much higher. I mean, you have your wide range igniting bar right here, and then this bar in the middle of the move comes in. Honestly, this is more like an ending bar. I mean, you're moving up from just over $10 by that point to what? 13 something? 30+% move on a 20-minute period? Look at the stock did the previous day. Nothing. You get a couple more bars, and then the sellers start to creep in. Right? The change of color bar from green to red, topping tail. Sellers are creeping in. It chops around, and look at the next bar. Big time topping tail. It happens to peekaboo a little higher, chop around, and boom. This is where the high-frequency trading machines are probably loving you guys. Peekaboo's over the top. I'm commenting because somebody asked me if this was a breakout. And I said, are you kidding me? That's craziness. Crazy talk. I want to buy OMI, at $15 for a breakout. The move is over. The move was over here. It was tired. If you were in it over here, you'd be really tightening things up. You'd be going down to a 2-minute chart or a 1-minute chart and just tightening your stop loss up because you already got a $4 or $5 move. I mean, what do they say? I always get this saying messed up. Hogs live, pigs get lives, and hogs get slaughtered. I don't know what it is. You guys know the saying. You guys somebody will come up with it. And the YouTube people are like, oh, it's this comment. You understand what I'm saying, okay? Basically, the gist is don't be overly greedy. Understand where you're at on the chart, okay? Understand where you're at on the chart. Bulls make money, bears make money, pigs get slaughtered. There you go, okay? Pigs get fat, hogs get slaughtered, all right? understand where you're at on the chart. Objectively read the chart. And I want to be clear. Once in a while, from time to time, occasionally, sometimes, they will bust your expectation and this stock will go to $20. That doesn't make it the norm. So follow the rules. Every once in a while, a stock will do something so out of kilter, you'll be like, whoa, wow. But it's not the norm. Follow your rules. Okay? It's not the norm. Follow your rules. Okay. Next one. Another ending bar. What's the expectation here? 1, 2, 3, 4, 5 bars up, and then it gaps up and leaves a huge topping tail on massive volume. So again, you have a little bit of an igniting bar down here. Now, again, this is not a pattern. This is not something you would buy down here. That's not the point. The point is understanding. The whole lecture idea is understanding when and where a stock might turn, where it might pivot. So in this case, the stock moves up. You have a wide range igniting bar. It goes higher. It goes higher. A little doji bar, a little concern there, but kind of normal where there's some resistance. Continues higher, and then it starts what? It has that blow off top. I mean, the stock went from $23 to $30 in 5 or 6 days. And then big time volume comes in with a topping. What's the expectation? Pull back, pull back, pull back. That's the expectation. If you happen to be in this long, I don't know why you would be, but if you happen to be in it long and you see this topping tail creeping in with that volume, you're going to walk away. You're going to walk away from it. Okay? Next. Here is how you can take advantage of some of these. This is a parabolic or a climactic play, whatever you want to call it. Drill down for a better entry. Okay? So here's a stock that's moving up, pulls back, breaks out, pulls back. Nice little buy setup right there. And the thing rips. It goes from 64 to 67 on a 2-minute chart. So this is like 2, 4, 6, 8, 10, 12, 14, 16, 18 minutes. That's a pretty big move for 18 minutes. Okay? If you look at the daily chart, it's even crazier than that. From 55-ish all the way to 67 in 4 days. That's a pretty big move. Now, I understand during coronavirus now, $10, $12 moves on $60 stocks don't seem all that special, but normally they are actually pretty special. I know our sense of normalcy has been just completely readjusted, I guess, in this particular market, this insanity market. I told you guys one of these days I'm just going to put the Q's in the SPY and when will the insanity stop, because it's insane. Okay? We have a new normal, but it's not going to last because it never does. The late 90s never lasted. They never do. But anyway, for the time being, it's a new normal for the time being. So anyway, the stock goes up 1, 2, 3, 4, 5, 6 bars. What happens? Volume, see it down here? Volume starts to creep in, as do the sellers. So now we have that stage 3 V-top tug of war. So after this many green bars, doji bar topping tail, big volume spike, this is an opportunity. Why? Because we've looked at the daily. The daily's extended. The 2 minutes extended. It's far from the moving average. We have topping tails. We have volume spike. You could short this at $66.50 with a stop at $67. Boom. And what happens? I would not have expected this to go all the way back to 63, but certainly at least a target of 65.50 and maybe down to 65 or 64.50, but certainly 65.50 would have been an expectation, 2 to 1. Okay? So lots of days up, plus you get an extended move here on the 2 minute, topping tails, doji bar, far from the moving average, volume spike. The stock's going to pivot. And in this case, it's something you can take advantage of. You can actually short it. Okay? Multiple concepts converging. Stock on the daily is moving higher. SPY is moving higher. We get a pullback here, moves up, consolidates, moves up, pulls back, rips. But note, there is your range expansion bar. But it had to rest before that was possible. Why? Because of this move over here. It was already up 3 or 4 bars. If you got this bar right here, pay attention. If you got this bar right here without these 5 resting bars, this is an ending bar. I'm going to repeat that because I need you to listen to it. If you got this wide range bar right here without these 5 resting bars, so you went green bar, green bar, green bar, and then this green bar, that would be an ending bar. But because we had the 5 resting bars, it's an igniting bar. So you see the nuance there? It's the same bar, but where it's happening on the chart really matters. If we go over to the left on the red bars, 1, 2, 3, 4, and the 5th bar is a wide range bar just above support at a rising moving average. This is an ending bar, right? This red bar is an ending bar, and then this confirms it. The bottoming tail suggests what? The balance of power is shifting from sellers to buyers. So selling pressure is decreasing and greed is increasing. And it's happening where? At support, on a 50% retracement, at the rising moving average, hence multiple concepts converging. And we get the daily strong with the market strong. Boom. Mic drop. That's good trading. All right. That's the type of trading that you want to be doing. All right. So in summary, okay, how does understanding wide range bars and pivots, how does it help you? Well, wide range bars, range expansion bars, and volumes helps us because helps us determine pivot points and reversals. Okay. Ending versus igniting moves. Selling too soon, long before your targets. All right. Get better entries on potential reversals, right? We looked at that one with the climactic play. You can get a better entry because you can see the reversal happening before other people see it happening. But don't forget, use those bottoming tails, use those topping tails, use the support area, use the moving average, use your pattern boosters out of PTS, just like we looked at on the last chart. Get the multiple concepts converging. You can also exit with larger profits at target before watching the pullback. Why? Because you'll see the volume. You'll see the wide range ending bar. You'll see the changing of color bar from red to green or green to red. Okay, so you can get out before the major pullback happens, saving you a lot of money. And then it'll also keep you out of bad trades. Knowing if it's an igniting versus an ending bar really matters. Okay, so if it's an ending bar, you're not going to get into that trade. If it's an igniting bar, you might actually get into that trade. Okay, so it'll help you determine all of these things. All right. And again, guys, I'm not here to talk about bottoming tails and support and moving averages. All those things are pattern boosters. All right. I mentioned them. Don't forget to use them, but that's not about what today's lecture is about. Yes, we did talk about multiple pattern or multiple concepts converging, but that's up to you. Those are different lectures we've talked about those things. Today, we're talking about mainly wide range bars, range expansion bars, and how with volume you can determine pivot points. But again, forest from the trees, multiple concepts converging. All right. So I hope that you guys learned at least a little bit out of that lecture. I think there's good quality information to be learned there. You just have to apply it. One of the things that frustrates me to no end about a lot of traders out there is they don't listen. Tell you to put together a pre-trade checklist. Do it. Do it. All right. Have a consequence system that's so severe that you won't break your trading plan. Then you don't have to worry about it because the consequence is so severe that following your plan actually feels comfortable because the alternative is really painful potentially. So put together a pre-trade checklist, always use good money management, and find a consequence system that's so severe you would never, ever think about breaking it. All right, so hope you guys enjoyed that lecture. I'm Jared Wesley. We'll get to it again next week.
To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.